Did you listen to me in mid-November when I rated SoundHound a buy? We get an implied share price of $8.50 compared to the recent close of $6.51. That's an almost 31% discount and is a buy rating. Well, since that recommendation, SoundHound has crushed the market by 5.8x. Don't worry if you missed out, because today, in under 20 minutes, I will provide what you need to know if you want to invest in SoundHound. Trading near $15 per share, I currently have a hold rating on SoundHound stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 2Q25 results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about SoundHound, and my conclusion on SoundHound's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 5 red flags to watch out for with SoundHound. If you're enjoying this, please smash that like button.
Let's just get right to it.
SoundHound posted record results and provided investors with many promising nuggets in their 2Q25 results, which I'm about to cover in detail. Let's cover the red flags first. They still lose money every year, so keeping the lights on could mean raising more cash. New cash can come from debt or selling more stock, which can dilute shareholders.
Yeah, it's a constant conversation because the opportunities are limitless in front of us, and I think we are at an inflection point for enterprise adoption of AI. It used to be, POC budgets or innovation budgets, but now it's a mandate from their IT budget, and they need a partner like SoundHound. So investing in growth is very important for us, but we also want to be as close to profitability so that we can decide when we want to get there.
On June 20th, 2025, multiple executives sold shares at the same time. With an early stage startup like SoundHound, these equity sales are common because that's how executives are compensated. The good news is that the company adopted an executive compensation clawback policy back in 2023. There is a 3-year recovery period of issued stock if accounting restatements occur, which protects investors.
Well, I think my money is safe.
SoundHound has about 92 million remaining of their prior 250 million equity distribution agreement. When used, more shares issued means dilution, a smaller slice of the pie for each shareholder.
Management is going to have to go back to the market, selling shares and diluting shareholders just to fund continuing operations.
The company admits material weaknesses in its financial controls. Weak controls increase the risk of errors or restatements, and it makes it harder to trust the numbers. Amazon Alexa's push into voice commerce and Google's cloud dominance provide a competitive edge. These tech giants have more customer touchpoints and greater distribution, which are big advantages over SoundHound.
Companies like OpenAI with ChatGPT, Google with Gemini, and others are coming for SoundHound's business because they have more customer touchpoints, more distribution.
Here's what got me really excited. Revenue surged like a rocket, 217% growth year over year. It was the strongest quarter on record. The momentum is real. Also, fiscal year 2025 revenue outlook was raised to $160 to $178 million. Growth in AI for automotive, enterprise, and restaurants, voice commerce is moving fast.
So you guys saw revenue that more than tripled in the quarter. And you have 3 main business lines. You've got autos, you've got enterprise, you've got restaurants. Where was that demand coming from?
It actually came from all of those. So it was a blowout quarter, strongest quarter on record. Every business unit delivered success. We had growth in AI for automotive, AI for restaurants, and AI for enterprises. We closed new deals. We had cross-sells across these units, which was amazing. We also made a lot of progress with our voice commerce, which is something we demonstrated earlier this year.
The Interactions deal is expected to be immediately accretive to operating profitability. And Q2 was a record on revenue, which validates demand. SoundHound supports many languages, which helps win customers globally. This diversifies revenue beyond any single region.
We are working with prominent auto OEMs, automakers in Europe, in North America. We have participation from restaurants and merchants with national and global coverage. That's going really well, and everyone is rushing to be a part of it.
Although we mentioned competition from Amazon and Alphabet, SoundHound has an estimated 400 patents after the Interaction deal. Patents protect pricing and can deter copycats. Pro forma cash pile of $270 million is massive. Tons of cash and no debt means more flexibility.
So our future doesn't depend on it. So we have the scale that we need now, but it's all about accelerating our market share and going into new verticals. So we went to With the last acquisition we had, now we are in the top 7 of the top 10 financial institutions. We are in healthcare, we are in insurance, we are in military, and more of that would be welcomed by us.
This is what everyone is missing. For an early stage growth company, SoundHound has done an amazing job rolling up acquisitions. In the niche and fragmented space of AI voice recognition, this allows the company to scale quickly.
We bought 3 companies last year, and those have gone amazing. We think we have demonstrated a repeatable formula for success. So first, we bought companies that were amazing on their own. They had great solutions, great teams, amazing customer base. And then we gave them what they needed to thrive. We replaced their legacy tech dependencies with SoundHound's own models that improved the quality of the user experience while lowering their expenses. We explored a lot of cost synergies. We did cloud migration, revenue synergies, upsells, cross-sells, which showed up in our financials. I mean, our financials speak for themselves. And all of that happened in 12 to 18 months. So we think we've become good at it, and we would be able to do it again, but it does depend on finding the right targets that are great on their own.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Nope.
That is what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year end, SoundHound had almost $200 million of cash, and after the Interaction acquisition a couple weeks ago, they now have $270 million of cash. While this is a positive and provides about 2 years of runway, they need to limit how much is coming from equity via paid-in capital, which dilutes the existing investors and is not ideal. Goodwill and intangibles appear as a result of significant acquisitions that they made in 2024. Sync 3 provides voice AI for the restaurant industry, enabling smart ordering and dynamic drive-thru. Amelia, a leader in conversational AI, expands SoundHound's reach into healthcare, insurance, and finance. The recent acquisition of Interaction extends SoundHound's leadership in agentic AI across enterprise businesses. Retained earnings is an increasingly negative number, which will continue through our projections until 2028, when net income turns positive. This is because the company has generated a net loss every year since it IPO'd back in 2021. We will see this next in the income statement. So what's the takeaway? While SoundHound has lots of cash and no debt, it can't keep relying on equity to fund the business long term. The true sign of an enduring business is one that is self-funded and does not rely on external debt or equity. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue has grown 4x in the last 3 years, going from $21 million in 2021 to over $84 million in 2024. Year-over-year revenue growth was an eye-popping 217%. The revenue growth rate has increased each year, which is very promising for investors. Gross margin has steadily decreased from 2Q24 to 1Q25, which means that the business is less profitable. The good news is that it popped back up to 58.6 in 2Q25. Hopefully, management can return margins to the 70% plus range that they enjoyed from 2021 to 2023. EBITDA has been consistently negative, and it doesn't turn positive in our model until 2028. This is because operating expenses are significantly higher than revenues. While the trend is downward, it has to be below 100% in order to generate profits and value for shareholders. So what's the takeaway? While top-line revenue is incredible, SoundHound needs to continue to reduce its expenses to create long-term value for shareholders. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is negative, and improving improves until it inflects in 2027. This is primarily driven by the growing net losses that SoundHound is generating. The good news is that we see low CapEx because this is not a CapEx intensive business. This is because technology produces a service rather than a physical product. The business is primarily being financed with equity, with 4 times more financing coming from equity relative to debt. In late January, they agreed to a shelf registration allowing up to $250 million more equity to be sold, and there is potentially significant future equity earnouts due to the Sync 3 acquisition as well as the Amelia acquisition. So what's the takeaway? The numbers don't lie, and we see some alarming trends of SoundHound funding the business and its acquisitions through ever-increasing amounts of equity, and investors need to keep a close eye on this. So what do I think about SoundHound and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build discounted cash flow models to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow of the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. Discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value of about $6.6 billion. We divide by the current shares outstanding, we get an implied share price of $16.27. Compared to the recent close of $15.12, this is a 7.6% discount, which is a hold rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you my thoughts on how to play SoundHound stock later in the video. So what does Wall Street have to say about SoundHound stock? Let's cover that next. Wall Street is very bullish on SoundHound, and analysts across the street have raised their outlook and price targets. Northland upgraded SoundHound to outperform and increased its price target to $14.50 from $8, a 181% increase. Northland upgraded due to a return to pro forma organic growth in Q2, and they see a strong second half pipeline and 36% second half growth potential. Ladenburg Thalmann upgraded SoundHound to buy and increased its price target to $16 from $9, a 78% increase. They upgraded post Q2 on accelerating traction in voice AI and large enterprise deals, improving fundamentals and visibility. D.A. Davidson maintained a buy rating on SoundHound and increased its price target to 17 from 15. They raised the price target after Q2 strength and ongoing momentum, keeping a bullish stance as growth expectations improve. CapIQ gives me a sense of how other analysts on Wall Street view the company. Only 8 analysts cover SoundHound on Wall Street, which is very few. The target price is from a low of 12, which is a 21% decrease, to a high of 18, which is a 19% increase. The median is 16, which is a 6% increase. The overall rating on a scale of 1 to 5 is 1.78, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do not have a position in SoundHound, but I do think it provides a compelling investment opportunity as long as you buy with enough margin of safety due to the massive volatility in the stock. If you decide to buy SoundHound, you need the right entry point, which I'll reveal shortly. SoundHound is stacked with close to 400 patents, which is especially important in the tech space. They are positioned well for the explosive growth in voice-enabled applications, and they have a unique tech stack, which combines speech to meaning, deep meaning understanding, and collective AI. This gives SoundHound an edge over traditional voice-to-text solutions. SoundHound's technology is perfect for customer service applications, but there are growing use cases in cars, drive-thrus, smart TVs, and voice-enabled devices. Truly a multi-industry opportunity. SoundHound had an all-time high of $24.98 at the end of December 2024, and it's down over 39% since then. In the last year, SoundHound is up over 211%. My model shows a value of $16.27, which is a 7.6% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So SoundHound is a hold at current levels, but if you're interested in buying SoundHound, I would be looking to buy below $13.50 in the $13 $13 to $13.50 range. SoundHound is a very exciting, though volatile stock with a market-leading position in the niche AI voice technology space. Management needs to continue executing, especially on the financial side, while minimizing shareholder dilution. I would not be surprised if one of the big tech companies decides to buy out SoundHound due to their superior technology. If you like this and want to see another in-depth stock valuation, check out my Lululemon video here or my Intel video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.